All right, today we're going to pull back the curtain on something pretty cool, the actual blueprint that professional analysts use to find order and opportunity in what looks like, well, total chaos in the financial markets.
You know the feeling, right? You pull up a price chart, and it's just this mess. A storm of greed, fear, all these emotions packed into jagged lines going every which way. It just feels completely and utterly random.
But what if I told you that what looks like chaos is actually a blueprint? One you just haven't learned how to read yet. See, behind all that noise, professionals don't see random chaos. They see a structure. They see probabilities. And today, we're going to walk through that exact blueprint.
Okay, so let's start building our map for navigating this market chaos. We're going to break down a real professional-grade framework you can use to analyze pretty much any market. Stocks, crypto, you name it. But let's get one thing straight right away. This isn't about having a crystal ball.
The goal here isn't to guess what's going to happen. No way. It's about building a solid logical case for every single decision you make. It's a total mindset shift, from emotional gambling to a structured, repeatable process based on probability.
All right, so what's actually in this analyst toolbox? Well, the whole system really boils down to three core components. Think of them as three essential tools that, when you put them together, create a complete map of the market.
First on the list is something called Elliott Wave Theory. Think of this as the storyteller of the market. It's built on this fascinating idea that markets aren't random, but actually move in predictable, repeating cycles, waves if you will, all driven by mass psychology. You know, the constant swing between optimism and pessimism. This theory gives us the grand narrative, the roadmap of where we might be in the market's bigger journey.
Okay, next up we have Ichimoku Kinko Hyo. It's a Japanese charting system. And if Elliott Wave is our big, overarching map, then think of Ichimoku as our real-time GPS. It gives us this incredible at-a-glance view of the current trend, the momentum, and whether the market is in a state of balance or, well, completely out of whack.
And finally, we have what is, without a doubt, the most important piece of the puzzle. This is the engine that drives the whole thing, the R-risk framework. This isn't some vague idea. It's a hard and fast, non-negotiable, rule-based system. It's pure math, and its only job is to tell you exactly how much to risk on any single trade, making sure that staying in the game is always priority number one.
All right, let's dive a little deeper into that first tool. How exactly do analysts use Elliott Wave Theory to start reading the market's story?
You know, at its core, the theory is actually pretty straightforward. It basically says that markets have two main phases. You've got a 5-wave move called an impulse, which is the strong push in the main direction of the trend. Then you get a 3-wave move, a correction, that goes against it. It's choppy, it's difficult, and the entire goal is to identify and trade with that powerful impulse, not get caught fighting the correction.
Now, this is what makes it a real system, and not just some kind of subjective art project. It's all governed by these super strict, totally unbreakable rules. For example, Wave 2 can't retrace all of Wave 1. Wave 3 can't be the shortest. Wave 4 can't overlap with Wave 1. If the market violates just one of these rules, the whole analysis, your wave count, is instantly invalid. You just throw it out. It's like a built-in lie detector for your own analysis.
Okay, so knowing the wave count is one thing. That's our big picture map. But that's all it is, a map. The real question is, how do you go from that big picture to finding a really precise, high-probability spot to actually do something? Well, it's all about a filtering process, kind of like a funnel. You start really wide, looking at the big picture on a weekly or daily chart. Then you start to narrow things down. You confirm the trend. Is the price above or below key levels like the EMA 200 or the Ichimoku cloud? You're basically asking, is the wind at my back? And only after you've confirmed that do you zoom in to identify a very specific entry zone. And that specific spot is what analysts often call the golden zone. Now, this isn't magic. It's an area they find using a Fibonacci retracement tool. It's based on these mathematical ratios you see all over nature, and it highlights a price range, usually between the 0.5 and 0.618 levels, where statistically a correction is very likely to run out of steam and the main trend is likely to kick back in. But here's the thing, markets love to set traps. They'll poke just past a key level to trick everyone into a bad trade and then snap right back. It's a false breakout. So how do pros avoid getting caught? They use a really simple patience filter called the rule of the close. Instead of jumping the gun, they wait for a candle to actually close its session. That confirmation tells them if a move is real or if it was just a fake out. Okay, this all sounds great, right? Super structured.
But let's get real for a second. Even with the absolute best analysis on the planet, you can still be flat out wrong. The market's going to do what the market's going to do. And that reality check leads us to, honestly, the most critical part of this whole plan.
It's this. Every single analysis has a built-in eject button. It's called the technical invalidation point. And this isn't just some random line in the sand. It's the exact price where your entire wave count, your entire story about the market, is proven technically incorrect. It's the point of no return where you say, well, I was wrong, and you get out.
So you see, all this work, the charting, the wave theory, finding the golden zone, it all boils down to one thing. It has to be distilled into a simple, objective, mathematical trade plan. And the crucial part, this plan is made before a single penny is ever put on the line.
And this is probably the biggest takeaway. Your position size, how much you actually trade, is never, ever a guess. It's not based on how confident you feel. It's a cold, hard calculation. It's based only on two things: how far away your entry is from that invalidation point, and how much of your capital you've decided to risk.
And this right here, this is what the final product looks like. It's a trading blueprint. A simple table, but look, every single variable is defined ahead of time. You have your entry, your stop loss, which is that invalidation point, your target, and your risk-to-reward ratio. There is zero ambiguity, zero emotion. It's just the plan.
And it's all built around that one little number, 1%. By predefining your risk on any single idea to a small fixed percentage of your total capital, let's say 1%, you mathematically guarantee your own survival. No single trade, no matter how wrong you are, can ever blow you up. It's a firewall for your capital.
So when you put it all together, this whole system, from the big picture Elliott Wave map all the way down to the nitty-gritty risk calculation, it's really about one simple idea. It's about figuring out which way the main tide is flowing and then having the discipline to ignore all those little choppy ripples that try to pull you in the wrong direction.
It's a complete shift in how you see the market. The goal is never to predict the future or eliminate uncertainty. That's impossible. The goal is to manage uncertainty with a rock-solid plan. So I'll leave you with this question. Now that you've seen the blueprint, does that market chaos still look like random, scary noise? Or does it start to look a little bit more like a puzzle you can actually solve?